This is certainly not a normal period in economic history. You can do more of it without consequence. How successful that will be, time will tell. $34.6 trillion in debt. Hey everybody, welcome. My name is Matthew. We're going to continue on here with our series on the United States national debt. There's been many videos so far. In my opinion, they're all helpful, but to give a good basis for what you're going to see today, I would encourage you to check them out in the playlist, the videos that were immediately preceding this one. So, what we talked about in those videos, we talked about the main components that all orbit and circulate around the United States debt. That is the debt itself. How much is it? The increase in the debt. What does that mean? Where does it come from? That's the deficit. What's the deficit? Well, it's the difference between taxes and spending. We also talked about the interest rate, which is very important when it comes to servicing the debt, paying the debt down. How much is that on an ongoing trailing 12-month basis? And finally, we talked about the money print. How much does the Federal Reserve print to subsidize that debt beyond what the U.S. Treasury issues to investors, whether they be foreign or domestic? It's a lot of things on the chart. We've gone through them all. Again, prior videos are there for you. We're starting to get to the brass tacks videos where I'm going to put these things together in hopefully a more helpful way so you can understand. So we can go to this chart now. The immediately prior video we talked about, let's do this now on a metric where we look at cents on the dollar. Okay, so for every dollar's worth of taxes received, which is the main way that the government's going to be able to pay its debts down and also continue to operate because the government has ongoing expenses all the time. For every dollar of taxes received, how much is the deficit? All right, and that was here. We talked about this last video. The only thing I want to reiterate in this video is the average. All right, you see it can be very volatile, huge upswings in the deficit during World War I, World War II, Great Depression. Even before the Great Depression, there was quite a big surplus, paid down a lot of debt. But on average, the number is positive. In this case, it means there is a deficit on average. How much is it? On average, this red shaded area, 28 cents on the dollar. It means for every dollar's worth of taxes received, the government spends $1.28, or 28 cents in deficit on average. And where are we today? Well, we had huge days of deficit spending post-GFC, huge days of deficit spending in COVID, and we went really far down in 2023 on a trailing 12-month basis, only 22 cents below the average, but now way above the average again. 69 cents on the dollar is the deficit, so more than double the average. Now, I want to answer the question, and I'm going to take off the deficit for a second, but I want to answer the question, how much is the money print? How much money is the Federal Reserve printing to buy government bonds and subsidize the money, the shortfall that there is in taxes to pay expenses? And for that, it is this black line here right now. So this is the print cents on the dollar, cents on $1 of taxes received during any trailing 12-month period. All right. Now, just very quickly, if you look at this, it's not that volatile. You see just a little bit here. It's pretty volatile during the Great Depression, Gold Reserve Act, a little bit post-World War II. Very volatile here. What does that tell us right away? And in fact, I'm just going to zoom in. Remember, we've talked about this many times. This is the important thing. All of the talking heads that you see on CNBC, on Bloomberg these days, the Larry Summers, Joseph Stiglitz, whoever, it doesn't really matter. They cut their teeth during this period, during the 70s, during the 80s, during the 90s. This is where they learned about tax and spend. This is where they learned about how the United States government can service its debt. And this is where they learned that deficits don't really seem to be a problem, especially post-Nixon shock. The deficits without tears, a mantra where basically the United States could export its debt around the world and people would buy it. People would buy the dollar. How much did they need to print as a function of the dollar? The Federal Reserve didn't print much at all. Look at these numbers. At any period over a trailing 12-month basis, for every dollar's worth of taxes, the federal government print and bought government bonds to the tune of 3 cents on the dollar, 2 cents, sometimes even a little bit negative, which means they sold bonds back into the economy. The Federal Reserve was a very minor player in the expansion of debt. How do I know that the Federal Reserve was a minor player in the expansion of debt? Because the expansion of debt, i.e. deficits, is going to be here. Let's put it back on. We talked about it in the last video. This is the expansion of debt here for, let's just read it out. July 1983. That means from the period August 1982 ending July 1983, for every dollar they received in taxes, they spent $1.40. So the deficit is 40 cents, right? For how much you spend beyond taxes, that's the deficit. And practically speaking, that is also the increase in the debt, right? And as you can see, the debt, let's even try to just zoom in exactly to show you. So put it July 1983, the debt was $1.34 trillion. And if you started August 1982, $1.12 trillion. So increase there, roughly $200 billion that year. And that was on the dollar received in taxes, a 40 cents on the dollar increase. All right, they received a dollar, spent $1.40. But look at the money print. Very small component of that increase. So this is what I'm saying. This is the disconnect between economists that believe truly in their hearts that deficit spending is not a problem. It's because this was a unique period called the Great Moderation in United States history where deficit spending was fine. The world was liberalizing, albeit slower, it happened faster after the Soviet Union collapsed. But foreign and domestic creditors were still lining up to buy United States Treasury bonds, notes, and bills. So it was not a problem for the United States to deficit spend, sometimes 10 cents over every dollar they earned in taxes, sometimes 40 cents, but it was not a problem. And it wasn't that necessary to print money to make up the difference, because that black line is the money print. Not much happening there. This is really, in my opinion, impressed upon especially a lot of the older generation, the old guard of economists, whether you're a monetarist, new Keynesian, doesn't really matter. You didn't really see deficit spending as being a problem during this particular period, during the Great Moderation. It was a problem here. It was certainly more volatile. Again, I've said many times, this is the Federal Reserve, founded in 1913, opened their doors in 1914. They view this period as kind of practice. And indeed, just looking at the United States debt, you don't necessarily know when a crisis is going to hit, because after World War I, all that the U.S. Treasury did was pay down debt up until the Great Depression. After the Great Depression, they spent more, borrowed more, and printed more. They did a lot of printing, particularly in this period, 1932. For every dollar in taxes, they had a deficit of $1.40. That means they spent $2.40, right? Because they spent the dollar they took in taxes, they spent an additional $1.40. So the total spending, $2.41. The deficit, $1.41. So this is where you can see the cents on the dollar component really drills down on things. Hopefully, we can see it in a simpler fashion. So still, war bonds, savings bonds, your civic duty to buy bonds, that was working quite well here during the founding of the Federal Reserve, the Great Depression, World War II in particular. Look, there was a little bit more spending here when the United States entered World War II. 20 cents on every dollar of taxes received here. It even went down a little bit as the United States entered the war. But the vast majority of the deficit was just regular borrowing. Do your duty, buy your war bonds. It was just regular borrowing. There was no money print to subsidize the deficit. You can see that the black line is very small relative to the deficit, relative to the increase in debt. And on cents on the dollar, you can see that pretty clearly. For example, May 1944, a year before World War II ended, the deficit was $1.50, and they only had to print 20 cents of that, 19 cents of that. That's what you're looking at here. They like to call this practice period for the Federal Reserve, and then they like to call this when they figured it out. Vietnam War, a lot of spending still. You see this red shaded area is spending, cents on the dollar, in excess of taxes. That is deficit spending, okay? As we talked about, won't review it again. The money print is not that much. And then you have this little balanced budget of Clinton, still money printed a little bit positive, but the deficit was negative 6 cents. Again, that means you took in $1's worth of taxes, you only spent 94 cents. You had a surplus. The deficit being negative means it's a surplus. So this very brief period, at the end of the Clinton years, we were running a budget surplus. But that's all that it means. It's not some miracle. And then, of course, you know what I'm setting up, you know what I'm getting to is post-GFC. Now you can start to see the role of money printing in deficit spending. Post-GFC, you had huge amounts of deficit spending, 100 cents on the dollar. That, again, it means you took in $1's worth of taxes, you spent $2. You spent the dollar's worth of taxes, plus you spent the deficit. You spent another 100 cents or another dollar. So in this period, August 2009, this was the peak crisis. March 2009, I think, was the lowest for the stock markets. This was a very, very intensive period of bond buying from regular creditors, but also by the Federal Reserve. Because look at the Federal Reserve's portion at this point. In January 2010, the deficit was 81 cents on the dollar. That means they spent $1.81. And the part that was subsidized by the Federal Reserve, just genuine money print, 68 cents of that. And here we can start to see it's not always perfectly aligned. The Federal Reserve tries to play with things, right? Look at the black line now. You can see the distinct QE1, QE2, QE3 as a percentage of taxes. This is the level of bond buying that occurred. But it's very smooth. The Federal Reserve was, Ben Bernanke at this time was telling the markets, I'm going to buy this much of bonds every week. And the market appreciated that. The federal government, the net of it is that the federal government was allowed to deficit spend a huge amount as far as cents on the dollar. Remember, I told you the average is 28 cents, lifetime average. The federal government here was spending 80 cents on the dollar. But the Federal Reserve was subsidizing a big chunk of that. And here, on a trailing 12-month basis, they have actually subsidized more than the deficit itself. It doesn't have to be just the deficit. The federal government could collect no taxes and just print 100 cents on the dollar. They could do that, but they choose not to. They presume that's not a problem yet, or not needed yet, but perhaps that will come. This is how their theory goes. Then this was a period of normalization. This is where they actually shrunk the balance sheet or kept it constant from mid-2014 to 2017. 2018, 2019, they actually tried to shrink the balance sheet. That's why you see it go negative here on the money print. So at this point, look at what's happening. The debt is increasing. The deficit is increasing because the deficits are an increase of debt. They're just individual years. You see that we're spending 26 cents. It's about the all-time average, 26 cents on the dollar deficit spend. That means we're spending $1.26 for every dollar received in taxes. But the money print is going down. It's negative. It actually means that the federal government is technically, they were letting the bonds roll off their books. They weren't buying any more bonds. But that's a surplus to say as far as printing goes. It's a selling bonds or letting bonds roll off their balance sheet into the economy and letting the market pick up that deficit. So if you looked at the Federal Reserve's balance sheet, it was going down when you see this as being negative. Then, of course, we had the repo crisis here in September 2009. It started to go up even before COVID. And then once COVID hit, the explosion. Look here. Peak COVID, we're at $27 trillion in debt. We deficit spent $1.28, $1.28 per every dollar in taxes. What does that mean? Again, I'll say it again. We received $1 for every dollar in taxes we received. We spent $2.28 for a deficit spend of $1.28. And how much of that was printed? 86 cents. 86 cents of the deficit was printed. They could have printed 300 cents, but they didn't. But it was still, you can see now, look, you can clearly see way different than our 60s and 70s period where the Federal Reserve thought they had it figured out. Every economist alive today who is 50 years older plus on TV talking believed that deficit spending was okay. And the money print was actually not that big a deal. Now, the money print is a bigger deal. Now, the money print is a much bigger deal as far as cents on the dollar of the deficit goes. And then we get to today. This is a very interesting period. So after COVID, we're still deficit spending. We're still increasing the debt. Biden suspended the debt ceiling. Remember, I told you the all-time average, 28 cents on the dollar is the all-time average of the deficit spend. The deficit spend for the government, we're at 69 cents. But look at this. The Federal Reserve is trying to normalize their balance sheet again from being at $9 trillion here, peak COVID. And I'll show you this in a following video. They're actually decreasing their holdings of United States Treasury bonds, notes, and bills. They're decreasing that amount. So their balance sheet again is shrinking. How long can that last? That is the question. Many people, and for example, the new fad of the day, and this has been in many recent years, of course, is the modern monetary theory, to basically say that deficits don't matter. It's basically the view of the Great Moderation period, 60s, 70s, 80s, 90s. You could have 40 cents on the dollar, take in $1 in taxes, spend $1.40, no problem. It worked. It seemed to work. Here, it's more complicated now. We're still spending, but we're not printing. Modern monetary would actually say print more. And believe me, they're going to start printing at some point. But we're at a very interesting period now where we have the Federal Reserve is trying to rein in inflation still, to lower the amount of treasury bonds that it holds on its books, i.e. the money printing. It's actually decreasing the money supply at this point in time. Okay, that's what it means when they are selling bonds into the market or letting bonds roll off their books into the marketplace. And this number is negative. This print, this black line number is negative. They are decreasing the base money supply. That's what this shows. It's a huge gap. It's a huge gap. We saw what difference that huge gap made here pre-COVID, and then it had to close just before COVID started. Then we had the crisis, and they blamed everything on the crisis, of course, but the economy was not healthy at that point. This is not a healthy delta. 69 cents on the dollar deficit spend, and the Federal Reserve is trying to not spend, but for how much longer can that last? $34.6 trillion in debt. By the way, I'll just tell you the average 5 cents on the dollar. So the average is not huge, particularly if you look at this period. Remember, it was only 1 or 2, 3 cents on the dollar. But if you take the big spikes from the big, troublesome periods in United States economic history over the last 100 some years or so, you just average all that together, these black lines. The money print is 5 cents on the dollar. It is roughly 1/6 of the deficit spend. Remember, 30 cents on the dollar, 28 cents on the dollar, the government will deficit spend on average. Now, at this very moment, they're doing 69 cents on the dollar, so they're more than double. But the print is typically actually not that high, which is why MMT people say you can do more of it without consequence. That's the key point to look at. If that cents on the dollar money print becomes very high for a long period of time, you're going to have high inflation and you're going to have structural problems within the economy. But they don't believe that's a problem. We're at a very interesting point in monetary history where you see this black line is becoming a bigger and bigger portion of the deficit spend. Right? That just means for the larger and larger deficits that the government takes, the more debt it issues, the more it borrows, more of a floor the Federal Reserve is putting under that market. They're buying a larger and larger component of that deficit spend, as you see here. And the problem is inflation, price inflation. So we can see this is why they've tried to normalize the balance sheet here in the late 2010s, and that's why they're trying to normalize the balance sheet here in the early 2020s. How successful that will be, time will tell. But as you can see, this is certainly not a normal period in economic history. Tensions are running high, and we'll keep tracking it for you. We're not done on this series of the United States national debt. In the next video, I'm going to actually go back and just look at how much the money print actually is as a component of this $34.6 trillion in debt. Let me know what you think in the comments. Thanks for watching.